This video is brought to you by FXCM. Open a $50,000 practice trading account by clicking the link below.
Well, it's a big day in the market today. A lot of adjustments going on. They look like they're probably short term to me, but it's hard to say. One of the biggest pieces of information that came out today was, of course, the tick data out of the U.S. We saw a big drop. So and in fact, we actually saw a negative flow of capital into the U.S. Or another way of saying that was we saw an outflow of capital from the U.S. So investors are seeking yield elsewhere. That's very useful information, very bad for the dollar. You wouldn't know that by the price action today, but it is. It's pretty bad for the dollar. So that's definitely something to keep in mind. In fact, if you look into the details of the tick data, the only thing that investors were buying were T-notes. So when the only thing that they're buying is government debt, that says a couple of things about the risk environment, that the traders are trying to avoid risk, getting into very safe investments. And if they're going for yield, if they want to take on some risk, they're going elsewhere to find it. So bad for the US dollar, good for the trend. And we'll see how this plays out. We're seeing some pairs just get hammered. The Aussie and the Kiwi are just really getting punished today. It will be interesting to see how this whole thing plays out and how the risk environment finally settles down. So let's get into the topic for today, which is leverage. And I want to preface this with there's a reason why I'm bringing this up. I've been in the business, in the Forex business, on the retail side as an investor and as a service provider, CTA and IB, for a long time, for many years. And I've seen the inside of what goes on in the Forex. What is going on with retail traders in general? There's actually, and we all know, we hear it all the time, that most retail traders aren't successful, blah, blah, blah. It doesn't mean they can't be successful, but what are the common pitfalls? Well, there's really only a couple, actually. There are a couple of problems that if most retail traders would solve these problems, they'd do well. I would say the biggest problem, because it's the one that gets you the fastest, is misuse of leverage, abuse of leverage. And part of this is that many Forex traders don't understand what leverage and margin mean and what's the difference between the two. And there's reasons for that, because in the Forex, they don't really fit the traditional definition of leverage and margin. But if we look at it, and oftentimes the way that leverage and margin are marketed at a retail investor is, you know, kind of flashy. It's 100 to 1 or 400 to 1. Well, what does that actually mean? So leverage, as the word implies, means that you're basically able to leverage more weight with less force. So you're able to make more investments with less equity in your account. So let's say, for example, you have an account that offers you 100 to 1 leverage. Well, what does that mean? That means if you want to buy a $10,000 mini lot, you're going to have to leave $100 of margin out of your total equity that just kind of sits in your account. Well, I've seen many Forex dealers advertising 400 to 1 leverage. Just a hint, it doesn't mean anything. They use that so they don't have to pay you interest. They collect interest on both sides. It's really only a benefit for them, not for you. But let's say that you did take 400 to 1 leverage. Well, what that means is if you wanted to buy a $10,000 lot on the Euro US dollar or something like that, you're going to have to leave $25 of your total account equity that's kind of thumbtacked as margin. Well, what that means is in practice in the Forex, because in the spot Forex it's a little bit different, because it's so liquid. One of the things that Forex dealers will guarantee to you, so while they get pretty close to guaranteeing stops and limits and things like that, and I realize is sometimes those get slipped, but one of the things that almost all Forex dealers will guarantee to you is that they will not allow your account to go into a negative balance. Well, because the Forex is so liquid, what that really means is that your entire account is margin. So the words leverage and margin begin to really break down in the Forex because it is so liquid. They don't give you a margin call, meaning that if you start to draw down on your account and going into a negative balance, they don't call you on the phone like a traditional futures broker used to and ask for you to deposit more money and to cure that margin deficiency. They just liquidate your contracts and leave you at a zero balance. So you could be on vacation for 2 weeks, come back and you have a zero balance in your account because the market ran away on you. Well, the danger of this, of course, is that let's say you're a small trader, you got $4,000 worth of equity in an account. Well, if you had 100 to 1 leverage, you theoretically have the ability to buy 50 mini lots. So Forex contracts. But 1 pip worth of movement is $50. So that could be great to the upside. It could be disastrous to the downside because let's take the Kiwi, for example. Today, the Kiwi's been running away on us. Let's say you missed 75 pips of that. Well, you just drew down on your account $3,750 because you'd maxed out the total amount of leverage that you could possibly use. So what's more reasonable? What if you were to constrain yourself to 2 to 1 leverage? Well, that means if you had a $5,000 account, you could buy 1 mini lot because, again, 2 to 1 leverage means a total equity of $5,000 and 2 to 1 max on the total account would be a $10,000 lot. 5,000 and 10,000 is 2. What about 5 to 1? Well, that's 2.5 lots. So you're starting to get the idea because 2.5 lots would be $25,000 worth of currency contracts. So here's the bottom line. Don't get caught up in margin levels, 100 to 1, 200 to 1. Here's a tip. It doesn't matter. In fact, if you will voluntarily limit your account to 50 to 1 leverage, if you're maxing that out, you're taking very serious risk, and I have an illustration for you here in just a second. If you're maxing that out, that's extremely dangerous, and most Forex dealers, so talk to your dealer, if you're willing to limit yourself like that, they will pay you a better rollover every day. So if you're in, let's say the pound yen or whatever it is that you're trading that offers an interest payment, if you're on the right side of that interest payment, not only will you get paid with the lower margin levels, but you get paid the best rate. So talk to your dealer. The good dealers do that sort of thing because it removes a little bit of risk from them. And I'll let you in on a little secret. There are dealers out there that will, in fact, mine their database and they'll look for traders who are over leveraged and just make bad decisions, just have a consistent record of panicking when they get over leveraged and exit their account, exit their positions at loss after loss after loss. They'll mine their database looking for those kinds of traders, and they will take uncovered positions against them. It's not unethical. It's not illegal. They take those uncovered positions because they know that that trader is falling into the trap of using too much leverage, and they reap all of the benefit, not just the spread. If I had access to that information, I would do the same thing. So, and I would assume that all of you would too. Don't be one of those traders who's just feeding their money into the market, and the misuse of leverage is one of the best ways to do that. So I promise to show you an example. Here's an example. This is a graph of an equity curve of a trading system that I'd mechanically backtested. Looks nice and juicy, right? Everything looks sloping up really well. This was at a moderate leverage level of 1 to 5. So very low. This isn't 100 to 1. This is 5 to 1. So very, very low amount of leverage, but nice growth there. Let's amp that up to 100 to 1 leverage. So you see the big difference. It changes things dramatically. As you increase that leverage, the equity is not able to sustain the drawdowns, and boom, I'm out of the market. So what was a profitable system with lower leverage is now a wildly unprofitable system because I was not able to withstand the shocks that will happen in the market. And I think today is a great example and a good time to have this discussion. So we'll be back tomorrow. Let's see what the rest of the big data looks like this week, which comes out tomorrow, and we'll see if we get any recovery in the market.
This video is brought to you by FXCM. Open a $50,000 practice trading account by clicking the link below.